So, good morning. I'm your instructor. I'm Joe Correa. I'm sure you've seen me in several of the Udemy courses. I'm very happy that you guys signed up to get started as loan officers. You're going to notice it's a very beautiful career because you learn a lot about mortgages, and at the same time you help people, but you get paid for doing it. So you can't complain about that. That's great. So what we're going to go over today is I'm going to tell you more or less. I'm going to teach you a little bit about the process, how it works, then what you guys are going to do, and then how you're going to get paid. And then finally, what we're going to go over is different examples so that you guys more or less know how the numbers work as well, because that's very important. So let's go ahead and get started now. I'm going to go ahead and share my screen, and then we're going to go over the presentation.
Okay.
Okay, let me see if you can see the screen. Can you see where it says product knowledge overview?
Yes.
Yes.
Yes. Mm-hmm.
Okay, excellent. So what we're going to do is this. I'm going to go ahead and start the presentation, and I'm going to go over everything. And then if you guys have any questions at the end, please let me know, okay? But in the middle of the presentation, I'm just going to go over everything in general, and then we can go back to a different slide if you guys wanted me to go over that slide again. So this is basically product knowledge overview that we're going to go over. Product basically means what are you going to sell? In this case, it's going to be different loan types for investors. So let's go ahead and get started. So what are investor loans? So basically, the types of loans you guys are going to be doing are for people that are purchasing residential or commercial properties, just like rental homes and commercial homes, non-owner occupied homes, and fix and flip homes. We don't necessarily focus 100% on fix and flip homes because our main goal is to have borrowers that are actually going to rent properties out. They're not allowed to live in the property. So if they want to live in the property, then that's not the loan we're going to be able to offer them right now, because this is going to be specifically for investors. So right now, we all know that the real estate market has been going up for a very, very long time, and interest rates keep going up. Eventually, or very soon, I believe, what's going to happen is real estate prices are going to plateau, and then prices are going to go down. And then when prices go down, a lot of the people that were able to purchase homes aren't going to be able to purchase homes. And that's when investors come in, and they're the ones that purchase homes at a discount. And a lot of investors, instead of purchasing one home for $500,000, if they have $500,000 saved, they could purchase 2 properties or 3 properties if they use half the money and finance the other half of the money. And that's where we come in, because we're able to grant them those loans by getting them these investor loans. Now, I already know that not a lot of lenders, but several lenders are preparing for what's coming. There's one big lender called Loan Depot. They already told everybody they're closing their doors October 31st. So there's lenders that are already preparing for that. Those are the common lenders that do regular conventional FHA, VA loans that people purchase, that get those loans to be able to purchase homes where they want to live in the property. So those lenders are already preparing. So we already know what's coming next. So we want to be a step ahead of everybody else by already being prepared to service those investors. And there's already investors looking out there for properties and good deals. So let's move on. So what's the benefit of having an investor loan? Now, this is one of the most important things. Investor loans, they don't verify income. The bank doesn't care how much the borrower makes or what job they have. They don't care. They just care that the rental income covers the mortgage payment, the total mortgage payment, which would include principal and interest, or if it's an interest-only mortgage, interest, taxes, and insurance. Whatever that is, they want to make sure the rental income covers that payment. That's it. It's that simple. So it's a much easier loan to do. Number 2, no employment. A lot of times you don't even have to put the employment on the 1003 or the loan application, which is a big benefit. Sometimes there are some lenders that do require that you put employment on the application. That's fine, but they're not going to verify the income. I've had borrowers that are sometimes security guards or teachers or police officers or attorneys or even doctors. And some of them only made like $1,000 a month, but on this type of loan, the bank doesn't care. You don't have to put the income. So that's a big benefit of an investor loan. They just have to have the money and a property where the rental income covers the payment. So let's go over number 3. Number 3 is basically less documentation. Most investor loans require limited documentation because we don't have to get any pay stubs. We don't have to get any W-2s. We don't have to do any verifications of income or of employment. So it saves time. It makes the process easier. There's less questions and more people get approved. Number 4, low credit scores. So credit scores a lot of times can go as low as 600 when investors are purchasing with 20% down, and it's going to be a loan where they're putting 20% down and they're not going to have their income verified. When they have lower credit scores, the only thing is they might have to come in with more money down, like 35% or 40%. And a lot of investors, they have that cash. So you don't have to worry about that. Now, let's go over number 5. Number 5, faster closings. So most investor loans, all that really matters is the rental income and that the property appraises. That's it. It's very easy. So for these types of loans, the loan process is faster. So a lot of times when the appraisal comes back, that's the thing that takes the longest. Sometimes appraisals, they might take a couple weeks, 3 weeks. It depends on how fast the appraisal can come back. That will determine how fast the loan is closed. Number 6, this is something important. In a lot of the states, I don't know, there's people in every state, and probably in this webinar, I have a lot of students from almost every state in the US, but there's specific states in the US that require that borrowers close in the name of a corporation. Other times borrowers, if they want to close in the name of a corporation, they can do that. So for example, if a renter's at their home and they slip or fall and they want to sue the landlord, in this case, if they close in the name of a corporation, they would sue the corporation, and the laws are different. So there's less of a risk. And that's what the bank wants for the investor, that they don't lose their money or lose the property. So they want to make sure that they're taken care of. That's why a lot of investors purchase homes in the name of a corporation. And the nice thing is they can open the corporation just before doing the loan or just before, a few days before closing the loan. The investor doesn't care if it's a new corporation. They're not going to verify income or anything like that. They just want to see the articles of incorporation, which means the corporation has been is active and effective. And sometimes they'll ask for an operating agreement, which is just a paper that needs to be signed on the bottom. The bank will provide us that document, so you don't have to worry about that. Number 7, higher loan amounts. So a lot of times when you go and you search for a property, an investor searches for a property, if they're looking to if there's somebody that wants to live in a property, which aren't the types of loans we're going to specialize in because those require a license, number 1. And number 2, they're not going to be very popular. In a few months, they're not going to be very popular at all because interest rates are going to be higher and banks are going to make it not impossible, but they're going to make it very hard for people to qualify for those types of loans. But investor loans are still going to be very easy to qualify for. The nice thing is that for these investor loans, a lot of the lenders, they can go up to $1 million properties so that you can have, some of them will have a minimum loan amount of $1 million. Other investors might require only $100,000. So usually $100,000 is what they require in terms of minimum loan amount. So that's important to remember. So if somebody's purchasing a home that's $200,000, you have to make sure that the minimum loan amount is $100,000. And then if they want to purchase a home that's $10 million, that's great. Just 1% commission of a $10 million property is $10,000. So that's a great commission. Now, number 8, flexible terms and conditions. It's very different when you have a conventional or FHA loan because the terms and conditions are a lot stricter. Banks do a lot of verifications because a lot of those loans need to be prepared in a certain way so that they can resell it to another investor, usually Fannie Mae, Freddie Mac, or another larger institution that purchases, or another bank that's even bigger than the bank that's doing the loan. And they repurchase those loans. And then that way the bank has, or the lender has money again to lend. But on investor loans, you don't have to worry about that because a lot of the things that they request are much simpler and easier. They just want to make sure, the lender just wants to make sure that they're going to get paid back. That's it. So back to number 6, in terms of closing as a corporation, I know Florida, I'm in Florida. In Florida, we are required to close in the name of a corporation. So if it's an investor loan, it's very easy. I even help some of my borrowers. We go to sunbiz.org and I show them how to create the corporation. They pay $75 or $125 and that's it. They didn't have to go to an attorney. They didn't have to do any long, lengthy waits for like a couple of weeks for documents to come back. And then they just wait for the state to approve it, which usually takes like less than 4 or 5 days. And that's it. And then we ask for a tax ID number from the IRS that gives it to you like in less like 10 minutes, you'll get an email with the tax ID number. So it's pretty easy. All right. How's everybody doing? Am I going too fast or is it a good pace?
Good pace.
Fine.
You're good.
Good.
Good pace.
Okay, guys. All right, let's go on to the next slide. So this is kind of giving you guys an overview of what you're getting into. And you're going to notice now that you're going to get into something which is in the very near future, what's going to happen. Because a lot of these lenders, when they're starting to close their doors, tells you what's going on. And when interest rates, the Fed is going to have the interest rates increase in the for the entire year, they're going to increase by 0.5 or 0.75. That's a big increase. It means interest rates are going to be much higher. So when right now interest rates are closer to the 6%, and on investor loans, most investor loans are either between 8, 9, 10% interest rates. It's not too far from 6 to 8. It's not too far. So it's not a bad deal at all. All right, let's keep moving. Let's go over definitions. Now, you need to be able to speak the language that the lenders that we're going to be working with are going to be speaking and the questions that they're going to be asking you. So there's main things that they're going to ask you that you guys need to know how to answer. So let's go over some of these terms because they are very simple. You just need to know what they mean. So loan to value. So loan to value is very easy. On investor loans, it's the same thing as on residential loans. So what's the ratio between what the loan amount is going to be divided by the appraised value. Now, I don't know if you guys have seen already in some of my courses, the bank or the lender, they always go based off the lower of the purchase price or the appraised value. So let's say somebody's buying $1 million property, but it only appraises for $800,000. Then the lender can only use the $800,000, and the buyer and the seller, they have to either lower the price down to $800,000 or the buyer would have to pay for that difference. So that's important to understand because that'll happen as well during the process. Now, let's say somebody's purchasing $1 million property and they're going to finance $800,000. So then it would be an 80% loan to value. Okay. And the abbreviation for loan to value is LTV, which is the term they use, but it's the same thing. You can say loan to value or LTV. It means the same thing. Now, debt service ratio. Normally, when somebody's purchasing a home, they call the relation between what the borrower is going to pay on their mortgage and their income. They divide both of those to get the debt to income ratio. In investor loans, it's simply called debt service ratio, and they abbreviate it with 4 letters. It's DSCR. So there's nothing to be worried about. When you see that term DSCR, all it means is how much is the mortgage payment divided by the rental income. So let's say the mortgage is $1,000 and the rental income is $1,000. 1,000 divided by 1,000 is 1. So a lot of times when they tell you that the debt service ratio or the DSCR can't be more than 1, that means that if you divide the mortgage payment divided by the rental income, and when you do that, if it's like 1.5, then the loan won't qualify. So either there's ways to solve that anyway. It's not a big deal because then either the investor has to come in with more money down to lower the loan amount so that the payment is lower, or they can try to ask for a higher rental income. Now, something that's very important. How do lenders determine how much the rental income is going to be? So sometimes investors say, oh, the properties are renting for $5,000 in that area, but they're not the ones that decide. What the lender is going to do is when the appraisal is requested to determine what the property value is, they are going to also request what's called, it's an appraisal for the rental incomes in the area. And it's called a comparable rent analysis. And what they do is the appraiser checks what the rental income is in that area. And that's what needs to be used to calculate this ratio, the debt service ratio. So it's very easy. A lot of times if you won't have control over that. I won't have control over that. It's whatever the appraiser puts on the appraisal. And most of the time it's fine because the rental payments all over the country are so high. I don't know if you guys have noticed, but rental payments are very high right now. So it's not going to, most of the time, it's not a problem. Okay, so loan term and amortization. This is something that's very easy. So the amortization of the loan term is for how long the loan is going to be for, which is usually 30 years. And is it going to be fixed for 2 years, for 3 years, 5 years, or for 30 years? Before, a lot of investor loans were only for 2 or 3 years, or sometimes 6 months. What that means is after 2 years, the investor had like 1 month to either pay off the entire loan, sell the property, or refinance. But now a lot of lenders allow investors to get a 30-year fixed, which means they never have to refinance. They don't have to sell the property to pay back the bank or anything like that. So it works perfect. So it just depends on what the lender wants. What the investor wants. What would be the benefit of having a 2-year, 3-year, or a 30-year fixed? Well, sometimes, let's say an investor is going to have with a 2-year fixed, it might be the interest rate might be, let's say, 7.5%. And with a 30-year fixed, the rate might be 7.75. So there's not much of a difference, but the loan is going to be fixed for 30 years. So that means they don't have to go through the hassle of refinancing or being forced to sell the property, even though the values are going down. So it works much better a lot of times to give borrowers 30-year fixed. So I usually try to give borrowers 30-year fixed when there's not a big difference. It would have to be like at least like a 2% difference or 3% difference to see a difference in the monthly payment. Now, the next thing I was going to talk about is interest-only payments. What are interest-only payments? Very easy. In investor loans, you're allowed to pay only the interest on the loan. So let's say normally when you pay a principal and interest payment, let's say the principal and interest payment is $2,000 per month, the investor can choose to only pay interest as the minimum payment on the mortgage and qualify only on the interest only. So let's say the interest only payment would be $1,500. So if the investor wasn't going to qualify because the rental income wasn't high enough, wasn't $2,000, it wouldn't cover the payment, it would be barely there. But now if we change it to an interest only loan and they're paying $1,500 and the rental income is $2,000, so now they're making $500 extra cash every month. And that's what's also known as cash flow. That's how much cash that's flowing in that's above what they're going to have to pay on their interest only payment. So that's another big benefit of having an investor loan. So they're allowed to pay interest only payments. Yield spread premium. They used to call this also YSP. This is important when it comes to what we get paid as a commission or compensation. Now, how many of you have already heard of this term, the yield spread premium? Have many of you already heard of this term?
Yes.
Yes? Okay, very good. So things changed after 2008 and 2009. Yield spread premium is basically you can have the lender pay you your commission as well. So, or pay us, the company, a commission. So how does this work? So let's say a borrower is going to have an 8% interest rate. And the borrower says, I don't want to pay any fees to any loan officer. Then you tell them, okay, no problem. So what you do is the lender's going to give you exactly how much the increase would be to get paid your commission based off the lender, which would be the yield spread premium. So they're going to tell you if you increase the interest rate by 1%, you'll get paid 2% yield spread premium. So let's say the interest rate is 8%. If the borrower tells you, I don't want to pay any loan officer fees, I just want to pay the minimum in closing costs, then you would increase their interest rate to 9%. And then you would get paid 2% from the lender. And a lot of lenders let you charge either a total of 3 or 4%, which means besides that, if there was a borrower that didn't mind paying 1 or 2%, you could make up the 3 or 4% compensation. So that's pretty good. That's not bad at all. Now, so that's something that a lot of people don't know about, but it's something that's important to understand. And then we already went over what cash flow is. I don't want to take too long on these terms because I want to talk about how you're going to get paid and how that works as well. But so cash flow, we already talked about. Cash flow is basically how much the borrower is making in excess after they pay their mortgage. So if they're renting the property for $5,000 and the mortgage, including taxes and insurance, is only $3,000, So 5,000 minus 3,000, they're making $2,000 extra after paying their mortgage. So that's called cash flow. And that's not as an important term, but you'll hear some lenders talk about that term. So it's better to understand what it is. Now, a lot of times when we work with lenders, they have somebody that's called an account executive, and they're going to be our contact. And a lot of times I'm going to give you their phone number, or I'll contact them and I'll get the interest rate. And then you're going to be able to learn by learning these definitions in these specific terms, so that when they ask you, does the borrower want an interest only payment? Do you know what the debt service ratio is? What's the loan to value? Then these things are going to be easy for you, because you at least know what they're talking about. And at the beginning, I'm going to help you with everything, so you don't have to worry about it. I'm going to make sure that the process is as easy as possible. And then you can listen in and learn how the process goes slowly but surely, and you'll still get paid your 50% compensation. So it doesn't make any difference. But at the beginning, I want you guys to learn, so it's important to listen in. Okay, let's move on to the next group of definitions. Prepayment penalty. Nowadays, when you buy a home and you get a mortgage, most lenders, they don't have a prepayment penalty anymore. But on investor loans, you do. And if the borrower doesn't want to have a prepayment penalty, they can pay 1%, 2%, 3%, up to 5% to not have a prepayment penalty. And a prepayment penalty is usually 1%. Like usually the first year, they can either decide to have the same interest rate. And let's say for the prepayment penalty, if they want to not have the prepayment penalty, they have to accept to have, instead of an 8%, they have to accept to have a 9%, but then they have no prepayment penalties. Then they don't have to worry if they refinance or if they sell the property within those, whichever the prepayment term is. So sometimes prepayment penalties are for 1 year, 2 years, 3 years, or 5 years. And then that 1 year, if they sell it before that 1 year, they might have to pay a 3% penalty of the loan amount. So let's say the loan amount is $1 million and somebody offers them $2 million and they want to sell that property. Then they might say, oh, I don't care if I have to pay 3%, which would be $30,000 in prepayment penalties. I'm going to make another $1 million. I don't care about those $30,000. So in some cases, it won't make any difference to them, but other investors, they want to hold the property for the long term and they don't want to have a prepayment penalty, or they don't care if they have a prepayment penalty. So that's something that you guys are going to learn, but it's pretty easy. It's not a big deal, but it's very common on investor loans. So let's go now to impounds and escrows. So impounds and escrows basically means some lenders give investors the option of paying taxes and insurance included in their mortgage payment, while other lenders allow investors to just pay their mortgage payment, their interest only payment, and then separately at the end of the year, they pay directly the county their taxes and the insurance company insurance. Most lenders, they prefer for the impounds or the escrows, the tax and insurance, to be included in the mortgage payment. And investors usually also prefer that as well. Just depends on the situation. Okay, buy down points. Now, this is a very cool term. So buy down basically is how you're going to save a lot of loans and how you're going to be able to help borrowers when you're competing against other lenders or other loan officers that are offering similar products. So sometimes I hear people tell me, oh, I got a 7% interest rate on an investor loan, and they don't qualify for a 7% interest rate. They only qualify for an 8% because of their credit or because of the type of property or whatever it may be. And what we do is this: you can buy down the interest rate by having the borrower pay an additional fee up front. So let's say they accept to pay 2%, and then their interest rate can go down to 6.999. And then all of a sudden you can beat the other lender, you can beat the other loan officer from the other for whatever company they're being offered. Or if the borrower didn't qualify with that 8% interest rate, all of a sudden by paying that 2% upfront as part of their closing costs, now they have a lower interest rate and now they qualify for the loan. So being creative, a lot of times, a lot of the loans that I close, banks can't close, and a lot of loan officers can't close the loans I close, not because I have better products or better services, only because I use creative problem solving. I think of these things, and it's not something that anybody else can't do. It's just a little bit of extra brain work. So buying down interest rates can be very useful when you're trying to say get a borrower to qualify, or when you're competing with other lenders. So buy down is a very useful term. Now, one that I like a lot is called a no DSCR loan. What does this mean? This basically means if the appraiser comes back and says the rental income is only $1,000 and the mortgage payment is $3,000, so the DSCR isn't going to qualify. The debt service ratio isn't going to work out for the borrower. The borrower isn't going to be able to get the loan. Then the borrower can accept to have a no DSCR loan where the lender isn't even going to qualify that ratio. So they're not going to calculate how much that difference is between the rental income and the mortgage payment. They don't care, but they're going to charge the borrower 1% or 1.5% higher interest rate. So I've done several loans that have been saved just because of that. So right off the bat, if the borrower tells you, oh, the rental income is kind of low right now, but once I fix up the place, the rental income is going to be higher, then you already know that's a hint. This is going to be a no DSCR loan because you don't want the bank to calculate the rental income and the mortgage payment ratio. So that's a very popular loan. I like to do no DSCR loans. Now, reserve requirements, they're not always going to be requested, but sometimes they are. Reserve requirements are basically sometimes when lenders ask for 2 months or 5 months in terms of savings of mortgage payments. So if the mortgage payment is $3,000, sometimes the lender might say, I want to see a bank statement showing $6,000 extra besides the down payment and the closing costs. No big deal. So most investors, they have that money. And then last thing I want to go over is lender fees. So lender fees are basically fees that the lender is going to charge. And all lenders have an underwriting fee. Sometimes they have a doc preparation fee. So what they do is they sub-hire an attorney to prepare all the documents, and they have to pay that attorney. And they also have to pay an underwriter, and they get a piece of whatever they charge the underwriter. So most underwriting fees are around like $900 to $1,500. Depends whatever they charge in underwriting fees. And sometimes there's processing fees or application fees. But those are all lender fees that go into the closing costs. So you don't have to really worry about that because we can't control that. All right, let's move on to more important stuff. Let's talk briefly about these terms, and then I want to talk about some other important things and go over some numbers. So I'm going to go a little bit faster, guys, okay? But I'm going to save the webinar so you guys can go back and review everything. So
yes. That's what I wanted to hear.
Okay, perfect. Let's do it then. Okay, so investment property, that's what you're going to be doing, investment properties. Credit criteria is basically what credit scores the borrower has. Closing in the name of a business is basically what we talked about, not closing in the name of a person, but in the name of a corporation. And the borrower can even put the property address as the name of the corporation. Right. So that's yeah, and that's a good idea actually. If when they're buying several properties, then they can separate each one. Minimum and maximum loan amounts. All lenders have a minimum loan amount, like we talked about. It can be 100,000 and the maximum of 10 million. Some lenders don't have a maximum. Some of them can you can purchase any purchase price. Repayment terms basically means the prepayment penalties we talked about and the amortization for how long the loan is. Foreign national is somebody that's not a U.S. citizen and wants a mortgage. And for these hard money loans, they're perfect borrowers because all they need is the cash, because they're not going to be qualified off their credit. Just they're going to get maybe a little bit higher interest rate. That's it. All right, the basic loan process. So this is what you guys are going to be doing. So we're going to start off with number one, a loan scenario. So you're going to obtain from the borrower exactly how much the purchase price is going to be, how much they're coming in with the loan with a down payment, so you'll know what the loan amount is and the type of property they're purchasing. And then you're going to email me as your loan coordinator initially to be able to look at the loan, and what we're going to do is I'm going to go ahead and obtain an interest rate and what type of terms they would get on that interest rate. And then you can go back to the borrower and ask them, would you be fine with this interest rate? If they only qualify for a 10% interest rate and they say, no, that's too high, then, you can tell them they can buy down the interest rate. You can offer alternatives. Other times when borrowers are fine with the terms, we move on and they sign the loan application, which is the 1003, and the submission form from the lender. Sometimes so that they can e-sign all the documents, they have to sign that form as well. But that's it. And then we're going to go over to your first client. Just like we talked about, we're going to get their information, and then we're going to schedule a conference call, which I'll be on the line with you. And then you can listen in and learn exactly what you have to tell the borrower and what you have to ask, so that the borrower is comfortable with the process, and so that you can get a feel for what they're going to accept for in terms of fees and interest rates. So let's move on to the loan process. So the loan, once everything is signed, it's going to go to underwriting. And then the loan is either going to be approved or denied. And then once it's approved, we're going to go over the conditions to be able to comply with those conditions. And we're going to send those conditions to underwriting so that the underwriter can clear those conditions. When they clear those conditions, we also want to make sure that we request the appraisal, which is extremely important. We obtain title documents, the insurance, and any other loan documents that are required in the process, so that we can get a CTC, which is also known as a clear to close. Once we get the clear to close, we can schedule the closing, and we're going to go ahead and obtain any last documents the lender needs. And then you're going to provide that closing package. If you don't receive it, we'll receive it as the mortgage company, so that we can pay you guys as loan officers, so that we have the documentation showing it closed. And then the getting paid part. This is my favorite part. So when do you get paid? You get paid when the loan closes and you provide the loan file for the borrower. So we get all the documents that the borrower already signed. We normally will have those already, but it's important that you guys also save those documents and provide those documents. And then whatever it is that we charge in total compensation, if it was 3%, 50% will go to you, 1.5% minus taxes. Because of 2008, 2009, the real estate crash, the legislation changed, and now we have to pay as a W-2. So we have to deduct taxes. For you guys, I think it's just 11, 12%. Depends on your state. But us as a company, we have to pay 18, 19%. It's almost 20%. And then usually we pay every Friday. And if it closes on that Friday, we'll simply move the payment to the following Friday, and you get paid as an ACH transfer. No checks, no waiting, none of that. You just get paid as an ACH transfer. In order to do that, what I'm going to do is I'm going to send you guys a link through our payment provider, which is ADP, which is very popular. A lot of companies use ADP. And then you put your bank account, your name, your social security number, all your information in there, so that the money just is transferred over to you. So pretty easy peasy there. Lead generation. So where do you get your borrowers? So it's very, very simple. When everything starts dropping in terms of prices, you're gonna meet investors everywhere. Your neighbors are gonna be investors. Your family's going to be investors, your coworkers, everybody that has a little bit of money is going to want to invest in real estate. And it's a great idea, because real estate eventually will go back up. So you get a discounted price. But besides that, you can also contact my favorite, which are realtors. A lot of realtors, creating trainings for them is one of the best way to bring in leads, because they already get the borrowers. So they might as well send them over to you to do the loan. Besides that, business partners, everybody you do business with, your insurance company, your accountant, doctors, everybody. Referrals. Once you have borrowers, you want to make sure you ask them to send you more borrowers. So if you have an investor and they have friends, ask them to refer those friends if they want to have the same service, the same interest rates, and the same speed that you're going to provide them. Social media is very useful. Investor seminars. I've done investor seminars back in Miami. I used to do a lot of investor seminars, because there was a lot of foreign nationals that were coming over and they wanted to invest in real estate. So I would do investor seminars in hotel rooms, hotel conference rooms. And it was quite interesting. It was very useful. Paid ads. So a lot of people use either newspapers or magazines, or even just having a car magnet in your car is another way to bring in leads, which is nice, because sometimes you don't expect them and they just come in. But the main ones you want to focus on, I'd say, is your business partners, realtors. And if you're good at social media, definitely focus on social media. I know there's Facebook, Instagram, YouTube, Google in general, and LinkedIn are the most popular that a lot of lenders use to bring in borrowers. So you want to make sure that you consider those as viable options. If you're good at social media, do it. If not, don't worry about it. You can grow them organically by focusing on realtors. If you do want to focus on realtors, I highly suggest you go to Facebook pages that have realtors or investors. Same thing with Instagram. If you want to create some YouTube videos and make them interesting, I've seen a lot of mortgage companies or mortgage brokers or loan officers who do that. On Google as well. And LinkedIn, for business relationships, it can be quite useful, especially when there's investors or builders or people that focus on fixing homes and flipping homes, those are always good contacts as well. All right, let's move to investor loan examples. I don't know if I'm going to have time to be able to go over all the examples, but I want to give you some math problems so that you guys kind of also see how it's done with numbers. So let's go over one right now. So if an investor comes to you looking to purchase a single family residence, a home, and they want to finance 50% of the purchase price, which is $500,000, and they want to know what their payments are going to be if they have an 8% interest rate and it's going to be interest only, what are their payments going to be? So in this case, we would take 500,000, which would be the purchase price times 50%, and we'd get a loan amount of 250,000. So that would be their loan amount times the interest rate, which you would simply multiply on a calculator, 250,000 times 8.5% and divide that by 12. And then we would get 1,770 as with 83 cents as their interest only payment. And if you hear a lender use the term IO, it means interest only. And then to calculate the prepayment penalty, let's say it's 3%, we would multiply 3% times 250,000, which would be 7,500. And that would be the prepayment penalty. So right now we ran out of time, guys, but if you have any questions, please send me some questions via email. If you have any questions, I'm very interested as to hear what you guys think. If you guys have any questions, if you guys have already taken the hard money course and the Jumpstart MLO course, that also helps out with some good examples.